we are going to be dissecting a step-by-step trading strategy that has 5 steps to it. Each step I have made as mechanical as possible, so there is no subjectivity. Starting with step 1, we're going to be looking at how to establish your directional bias using market structure. This is going to give you the insights into how to predict where the market is heading based on where it's come from. Step 2, we're going to be walking through supply and demand. More importantly, selecting our right order blocks for our points of interest. These are going to be the areas that we're going to be trading out of. Into step 3, we're going to be taking a look at the cause and effect model of the market, which is liquidity. This is going to help us avoid certain areas and target other areas. Into step 4, we're going to be taking a look at multi-time frame analysis, so we can tie all the pieces in together from a multi-dimensional perspective. And step 5 is going to go over our entry, our management, and our targets. Without further ado, let's go ahead and get into step number 1 of a pullback or extension before reversal. That's the mechanics behind it. What does that mean? Okay, we have a high and we have a low. The furthest point that price pulls back is right here before reversing and give us an extension, and the furthest point of extension before reversing is here. Then the highest point of the pullback is here. Then the highest point of the extension is here. So we still have our swing points. The only thing is that there are these internal pieces of price, like I've marked out here, where people, can tend to get confused. And really keeping it super simple, using the framework, it's the external swing points that cause reversals. So wherever you see a reversal in swing structure, that is what you would call your swing point. That is what you refer to as your swing structure. And it's those that give you your directional bias. So just as we did with here, our bias was continuing playing short, some level of pullback after a break of structure, and then continuing lower. The same is going to be true for the reality of price action. However, it's going to just probably deliver itself something along the lines of this. But all in all, we're still taking price into the same area. Our bias remains the same. We just have what looks to be more complex. But in truth, it's no more complex. It's the same principle applies. You map out the furthest point from the pullback that has the reversal, and then you map out the furthest low. And again, your expectation would be to pull price back up and take price lower once again. So that is understanding and directing our bias. It's super simple, and we're going to take a look at what that's going to look like now when you come into the charts themselves. So we're on the 4-hour time frame for this step-by-step strategy, and we're going to be mapping out our structure. So again, let's imagine this is the low, this is the high, and price is just put in a higher high. So we've had a break of structure. So we can understand, because of the break of structure upwards, that price is trending bullish, right? So because of that, the probability then that we've confirmed is that our directional bias is bullish. So essentially we're waiting for some sort of pullback before some sort of extension that breaks structure to the upside. So we mark out our lowest point of the pullback and our highest point again for the pullback. So let's say, hypothetically speaking, you couldn't see anything that was past this line right here. Price has just broke structure to the upside, like so. Now, what are you expecting if you can't see anything on the right side? You're expecting some sort of pullback respecting this low right here, and then going and breaking structure to the upside, because the probability is that price continues in its uptrend. And that is how we build our directional bias on the charts. And again, our higher low, meaning the low that is higher than the previous low, is our last point before reversing. So it's the deepest pullback in the leg, which is this low down here. And then you expand to the high after the break of structure. The highest point that price goes before it begins its pullback, which we understand is here, because after price breaks structure and puts in this high, then it begins to pull back. And again, the deepest level it pulls back to before it breaks structure again above the high is this point right here. And then it goes and breaks structure again. And then it pulls back and then it breaks structure again. So you can see that, you know, let's say hypothetically speaking, we weren't able to see price action after it developed. We were waiting for price action to develop. But based on our directional bias, we would have bet long every time. After price breaks structure, we're expecting pullback, continuation. We have the pullback, we have the continuation. We're expecting pullback, continuation. We're expecting pullback, continuation. Now, at some point in time, there is going to be a change of character. Change of character being the process of bullish price action to bearish price action. Now, the point in which this takes place is completely unpredictable. You can't predict it, but you can react to it when it happens. And the statistical probability is somewhere around 70 to 90% of the time, price will continue in its trend. Meaning, if you have 10 price legs, right, that move in one direction, between 7 and 9 of those moves are going to be continuing in that direction versus, you know, 30 to 10% of the time they're going to reverse and give you that change of character. So with that information, we can understand that more times than not, when price has broke structure in one direction, it's going to pull back and continue in that direction. And by knowing that information, that gives us our directional bias. And you'll see how that plays into live markets when we get to that. So what happens here is price goes from being bullish to being bearish. We actually have our change of character. So as you can see, price made a higher high. This is our final break of structure right here. And from there, price, instead of going to put a higher high in, which you would probably expect, price changes character and puts a lower low in. And again, price breaks structure, gives a low, and then price reverses, meeting our pullback criteria, which is 3 candles in the opposing direction. And then it puts in a lower low. Then price pulls back. And now here's a very key lesson for you guys to take away as a part of the rules for this system. That is that if price takes out the high, but does not break and close, it doesn't count as a break of structure or change of character. What we consider that is a liquidation. So if it breaks the high with a wick or breaks the low with a wick only, it's just a liquidation. Price wanted to gravitate to that area to collect whatever orders or stops that were in that area. So we don't consider it a change of character or a break of structure. So with that out the way, price essentially puts in a lower low. We have a break of structure right here to the downside. So at this point, when we've changed character, we pull back, we broke structure, what we're expecting is some sort of pullback without breaking this high and closing, and then some sort of lower low again. And lo and behold, that's what takes place. We come back up, we liquidate the highs, and then once again, we break structure to the downside. So that right there is our break of structure. Now, when it comes out to mapping out our low, you probably think that this is our lowest point, and then this is our next highest point. But the issue here is that it doesn't meet our set rules. The rules are that price must have 3 candles in the opposing direction, meaning if price is bearish, then for it to be considered a pullback, it needs 1, 2, 3 candles before putting a low. If we have bearish price action, 1, 2, 3, then this isn't a pullback right here. It doesn't count. It just counts as the entire leg. So if we take a look at that, it actually ends up being, this is not a pullback. This ends up being the low. And then this ends up being the high. So this high to this low is the price leg. And this is everything in between is just a part of that price leg. Now, the key differentiation here when we look at structure is, let's say price is bearish like it is in this example, right? Let's say price pulls back. It doesn't break the high. Then it pulls back and then it breaks, right? The key differentiation here is that the structural high isn't this high right here. No, it's this high. because everything until this low breaks is contained inside of that price leg. And only when that price leg breaks do we have a new price leg. And the high of that price leg is this high, not this high. However, when we come into supply and demand, as we will in a moment, you will understand that this is the final point of supply that broke this structure. And so instead of price coming up and breaking this high and still respecting the high and taking the low, what will likely happen, 7 times out of 10 is that it will respect the decisional area and then put in a lower low, as we will get on to see in just a moment. So after price breaks structure, like it does right here, essentially our directional bias, our directional understanding is that price is going to then go and take out the low, creating another lower low right here, right? And as it does, so price just continues on its bearish trend. So that is essentially how we understand our directional bias from a technical perspective. And even if I pull price back into here, now let's imagine, right, hypothetically, that you're not able to see what's going to happen with this right now. So this is the only picture you've got. So we know we've had a break of structure to the downside. So we know that our directional bias is bearish. What you are waiting for as a trader is for price to pull back and then break structure. And it's your job then to get into the position on the pullback and target the continuation, because our directional bias is that price is going to continue breaking structure. And so this is how we use that directional bias to understand where it is that we want to get into the market, and more importantly, where we're heading overall based on where we've most recently come from. And then we tie in step 2 to step 5 as add-ons to get into that. So our directional bias right now is that we're going to have some sort of pullback before continuation, and we want to short at the edge of that pullback. But there's only one way to understand how we're going to get into that position, and that is with our order block, which is our supply and demand. So let's move into part 2. So step 2, understanding supply and demand. And again, we're going to apply our principle of keep it stupid simple. It doesn't have to be overcomplicated. So we have to, obviously, because this is chronological, if we're going to be looking at scenarios, we're going to have to understand our directional bias. And so we already know, based off last time, our directional bias is bearish. So what we're looking at is some sort of pullback before going lower. That is our directional bias. Now let's understand how supply and demand plays into this, and what is supply and demand. So simply put, a supply is an area of sell coming into the market, and demand is an increase in demand into the market. If there is a supply that enters the market, meaning a supply of something, then the price goes down because there's more of that than there is demand for it, thus lowering the price of something. The perfect example of this, right, is in economics. That is where supply and demand comes from. Let's say you have one apple, right? So this is your apple right here. And let's say you have 100 people, and all of those 100 people want that one apple. So there's only one supply, but there's 100 demand. Now, the thing is whoever's going to get that one apple is going to be the person who's going to pay the most amount of money for it. So let's say the first person offers $1, and the second person goes, no, I will take it, I will offer $2. All the way up to the 100th person increases the bids to $100. I will pay $100 for that one apple. There's only one apple. So whoever bids the highest price gets the apple. That is an example of an outweigh in demand versus supply. What that does is it increases the price for the thing. It pushes price up. Now let's take the contrary example. Let's say there are 100 apples, right? There are 100 apple stands. You go to the market and there are 100 apple stands. 100 stands, each selling one apple each, right? And let's say there is one person. There is one person, and that one person wants an apple. that one person has 100 different apples to choose from. Now, let's presume that each apple is as fresh, as new, as green as all the other apples. So they're all equal in value. Now, what you will see happen is that one person who wants an apple, there is one demand and 100 supply. So let's say that person goes to the apple and one of the apple owners goes, I want $100 for my apple. The person can be like, okay, I'll explore my options. He will go to the next one. The person's like, I will give $99 for that apple. The third person, he's like, you can have this apple for $95. You can have the apple for $70. By the time he gets to the 50th person, he's like, you can have the apple for $20. By the time he's been through all different apple suppliers, it's whoever can give him the cheapest price for the apple that is going to take. And so maybe you get down to the final guy and he says, you can have this apple for $1. So there is an abundance of supply and a lack of demand. That means that price has to come down to fill that demand, meaning that price has to come down to $1. Versus in the other scenario where there was an increase in demand and a decrease in supply, price had to go up to meet that demand. You get what I'm saying? So it's so simple, and it's the exact same thing when it comes to supply and demand in the market. It simply is when supply comes into the market, price decreases. So when you see price come down, like this leg right here, all that is a supply come into the market. And then you see demand come in and price increases. And then supply comes in and price decreases. Demand comes in, supply comes in. So when you're seeing price go up and down, all that is an increase in demand and an increase in supply. And so supply and demand and order blocks, they're just fancy words for buying and selling. Now, how this becomes of interest to us, we'll get into shortly, because there are specific areas where more demand or more supply comes into the market. And as a matter of fact, let's say the person who wanted to sell 50 apples, right? So they want to sell 50 apples, but there aren't 50 buyers. So what will happen is maybe this is the price that they wanted to sell those 50 apples at. And when price gets there, only 25 apples were sold. So there's still a 25 apple order sitting in that area, waiting for price to come back in to collect those orders. Now, the seller of that apple is solid on his price. And so this is where the supply is. Demand comes to meet that supply. And when you get there, supply kicks in and pushes price down. The same is then going to be true again. Let's say there are abundance of sell orders in here. And then demand comes in. But once demand comes in, it meets that area of supply where there are a bunch of sell orders. And in doing so, once price gets to that area, those sell orders are triggered into the market, causing sell orders to come into the market, thus pushing price down. It's that simple. So there are specific areas where those buy and sell orders are sitting. It's our job to identify them, and that's what we use when we refer to order blocks. And it's going to be more easy for me to show you when we get into the live charts, but let me run you through the theory right now. So let's say, for example, we're going to use the easy, simple example first, which is the expectation of one supply and demand zone in each area. What's going to happen is in a downtrend, overall, for the whole trend, there's more supply coming in the market than demand. Supply outweighs demand. That's why price continues to go lower. But still in that area, there's still going to be a fluctuation between supply and demand. Supply comes in, demand comes in, then more supply comes in, then some demand comes in, and more supply comes in. That's why you see the price chart go up, down, up, lower, low, lower, high, lower, low. And it's just that filling in those orders of buys and sells. So let's take this example right now. Supply comes into the market, and we can identify that there's an area of supply right here where we believe there is an excess of orders, given the framework that we'll go to when we get onto the charts. So that is what we map out as our supply area. So price comes down, and then what happens is there's too much supply. So demand comes in. What happens typically is as price goes down, it becomes more desirable for the buyer because the price is becoming lower. So when it gets to a certain point, demand comes in and people say, you know what, I'll buy it at that price. I think it's worth that price. So then what happens is you have a demand zone that's formed in here because demand starts to come back into the market. And then what happens is once demand takes us to that price where there are more sell orders, then the supply gets back into the market and people start selling again, which pushes price down. Now, if our directional bias is going lower, and that means that the market wants to take the price lower, those in control of the market. So the banks want to take price lower. So what they do is there is an excess of supply orders against demand orders. So when you meet with area of supply and they come in, when it gets time to go to the demand area like this, there may be some interaction, and then price just continues going lower. The reason for that is because there are more sell orders than there are buy orders, and it's just simple supply and demand economics. So then what happens is price breaks structure, and the lower price gets, the more a discount price becomes. And so at some point, right, there's an area of supply that caused price to continue going down again. And at some point, demand comes back into the market. And that's why you see price reverse. It's like, okay, supply comes in, okay, demand comes in, then demand interacts with the area of supply and price comes back down. You get to where there was some demand, but there's more supply than there is demand, so price continues moving lower. That is, as to say, when price is bearish, supply is in control. When price is bullish, demand is in control. Now, in an ideal world, that is what it would look like. That is what our expectation of supply and demand would be. But now let's go into the reality of how supply and demand is going to be. So let's say we're going to still understand our bias. We need to understand our bias. So our bias, we're going to be marking out swing points. We have a low, lower low, lower high, lower low. Remember the furthest swing point before price break structure. So price break structure right here. So between the high and the low, where is the largest pullback point? That is in here. And then price breaks and then it reverses. And then where is the highest point? Is it this one? Ah, no, because then price comes higher again. It's this one. And then price breaks structure to the downside. So those are our swing points. And all in all, our bias is bearish. But how would supply and demand interact with this specific scenario? Let's take a look. So price comes down, which means supply enters the market. And then demand comes in, which means demand enters the market. That's why price goes up. But as demand comes in and meets supply, more supply is released into the market, more than there is demand. So price continues going lower. In doing so, obvious course, as price makes its way to the downside, price leaves an area of supply. But then demand comes into the market. So demand comes in right here. And then this is where we start getting to realistic. Then some supply comes into the market because price moves back down. Now, at this point right here, what you're seeing is there is a demand for this asset at this price right here. Then it pushes up and then supply comes in. Supply meets that demand. And at that specific price point, there is more demand than there is supply, which is okay because what that tells us is that price is just on its way for a pullback. That's simply it. Price is just put in a lower low and now price is pulling back up in to collect those areas, orders of supply. So price then enters into our supply zone and of course on its way, it disrespects this supply zone. More demand comes into the market. More demand comes into the market. It enters the supply zone. Some of the supply is released back into the market, pushing price down. But then it meets with demand and there's more demand at that set price. And then price increases because there's more demand than supply. Price collects more supply from the level. Now, if price continues and goes lower and breaks the area of demand that just pushed price up, that is just simply an imbalance between supply and demand. And so whatever there's more of, price will move in that direction. In this case, there is more supply orders than there is demand, which doesn't surprise us because we understand directional bias. We already knew that price was bearish because we broke structure. So it was more likely that the high would be respected and the low would be disrespected. So we already had an edge over the market before it even happened. And this is how it happens between supply and demand. So what happens is we enter the supply comes in, right? More supply comes in, pushing price down. We don't break the low yet. All of a sudden, a new demand comes in for price, and then price comes and pulls itself back up. From the demand, it gets met with areas and orders of supply. It just so happens to be that there are more supply orders than there are demand orders, which means price goes down, and price takes out the area of demand down here and takes out the low down in here. Then what happens is as price pushes down from here, it takes out the area of, it releases, an order of supply. So that supply comes in, which is right here. Then as we put in our low at this discounted price, demand gets back in. There's an interest, there's a demand for price. So demand comes in. Then a little bit of supply comes in of people who want to sell at that price. Then there is another infusion of demand. And then there's another infusion of supply. And then there's another infusion of demand again. So we can see that demand comes in, supply comes in, demand comes in, supply comes in, demand comes in. Now on its way back up to the high, it may seem like there is more demand than supply because at that specific price there is. But with our directional bias, we understand that the bias is to go short. So there are more sellers involved in the market than there are buyers. That's why the algo is pushing price to the downside. So with that information, we understand that at some point, the likelihood is that price continues going lower, meaning there'll be more supply that comes into the market than anything else. So as price gets into this area and pushes price down, there is more supply that comes in than there is demand. However, it's not uncommon for something like this to happen. Supply comes in, and then a newfound demand comes in and pushes price and takes out the highs. But we still remain inside of this supply level and we still respect our high. And then supply comes back into the market, breaking down the low in here. So in doing that, price again leaves an area of supply. And now we're left in this scenario. By using our expectational understanding, we can expect that price will come back into an area of supply before taking price lower. That is the bet that we're taking. We're taking our bet on mapping out our area of supply, price break structure, we pull back into our area of supply, we respect it, supply comes in and moves price down, and we simply get involved in those supply orders ourselves, and we allow the market to take us with it. It's literally like getting in a lake. The lake is flowing, the river has a flow to it. It's flowing in one direction. So is the market. The market is flowing short. And all our job is to get in the river and let the river take us to where it's going. In this case, the river's bearish. And all we're doing is waiting to get in the river. We get in the river at the right place, and then it just takes us with its current bias, its current direction, which in this example is bearish. So now let's take a look at how we can apply that to the charts. So now we're going to take a practical approach to supply and demand and give you what we refer to as order blocks. Now again, keeping it stupid simple, this is the framework that we use. Now we understand that when demand comes into the market, price moves up, and when supply comes into the market, price moves down. Now what you will find is that on these moves up and down, beforehand there is first a supply area that comes in and then a demand area comes in. Now how we mark out our supply and demand zones is when demand comes into the market, the final sell to buy is what we use as our zone, and then when the price comes down, our final buy to sell is what we use as our zone. So what you can map out here is a bearish candle followed by an impulsive bullish candle. And then the same is true right here where we have a bullish candle and then an impulsive bearish candle. That is going to be our supply and demand zone. So this is our supply zone. We'll map this back out in our normal gray. And this is our demand zone. And so what price will act as is a catalyst for price to pull back and continue. Same for the supply zone. We'll pull back and then continue. Now, the differentiation between these and how we decipher what we use is a term called imbalance. So the supply demand zone should have an area of imbalance. We calculate imbalance like this, and again, it's mechanical. If you look at these examples we have right here, which are stupidly simple examples, let's take every impulse, so this, and this as their own candlestick. So what happens is our first candlestick is bearish, our second candlestick is an impulsive bullish, and then our third candlestick is bearish. The way that we calculate imbalance is when the first candle and the third candle don't touch each other. They have this gap in the middle, and that gap right there is called imbalance. Again, let's look at that from this example. We have a bullish candle, an impulsive bearish candle, and then a bullish candle again. The first candle doesn't meet with the first candle. That is imbalance right there. Let's look at an example where price is balanced. If let's say we have a this, and this. Now when you look at it, the final sell to buy where momentum comes in, notice how the first candle also touches the third candle. There's no gap in between. Gap, no gap. Gap, no gap. That is imbalance. Simply put, how to understand this is that at that specific price point, a momentum came into the market that was imbalanced, meaning there was a unfair portion of one side of the market that come in than the other side, not allowing liquidity to be available to the other side of the market at that specific price point. That's how we understand imbalance, and price has to always come back and fill that imbalance at some future point in order to make price efficient, fair. So that offers that price to every single market participant at that price. So that's how we understand efficient versus inefficient, or balance versus an imbalanced price. So let's apply that now, that concept, to the charts. So let's start off right here, and let's start with, anything after this green line. So what happens is we have a high, and then supply comes into the market. So where is our supply? We need to count the candles, right? We have the bullish candle, then we have the bearish candle, the next bearish candle, the next bearish candle, and the next bearish candle. So supply comes into this market. Now notice there is an imbalance in here somewhere. It's the gap. If we take this candle right here, right, this bearish candle right here, then we take the second bearish candle and the third bearish candle, notice that the first candle finishes here and the third candle begins here. That gap in that middle is called imbalance. And so every time that there is an imbalance in price, that is where we know there is an area of supply if price is coming down, or demand if price is coming up. The reason for this is because an excess of orders have come into the market at that specific time. So we understand that that's where smart money have left their footprint. We know that a large portion of orders have come in to the market at that point. That's not to say that every area of supply and demand will be respected. That's just how we map out our supply and demand zones. We'll get into the specifics more in a moment. So that is the first point of supply that comes in, and we just map it out as the final candle that the momentum came in that left imbalance. It's that simple. Then what happens? Then demand comes into the market. So price begins to push to the upside. What happens there? Essentially, if you count the candles, you'll understand that this candle right here, a bullish candle, followed by another bullish candle, followed by a bearish candle. We understand that the first candle finishes in here. So the first candle finishes here, and the third candle starts here. Notice the imbalance is here. So then we have a demand zone to work from. And notice that how straight away from that, as that demand comes in, it fills the imbalance of the supply. Then price goes up, and as that demand comes in and the imbalance created, it gets filled again by this area of supply. Then what happens is price comes down. Price is fully efficient, so there's nothing that price will react from in this area. Price is completely efficient. And then again, demand comes in. Price pushes up aggressively. What does that aggressive move do? It leaves behind imbalance. Again, if we take our, bullish candle, bearish candle, and we just map that out there, we know then that that right there is our area of demand. So again, we're going to take the first candle starts and the third candle starts there. And so between that, there is a gap, which we know to be imbalance. Now, typically speaking, what will happen is there'll be some sort of interaction out of most of those areas of demand. So what that will look like is, as price gets in there, price may not continue in that one direction. Price may disrespect the area, but what you will see happen is there will be an interaction, meaning when price gets into that zone, there'll be some reaction because it's filling the orders. And then again, if price wants to continue moving lower, it will just disregard that area, but there will be some level of reaction in here. What we do is we identify these areas mixed with bias and a couple of other things that we're going to go over, and we use those as our catalysts, our points of interest, that we expect that could be an area that has a reaction, and we try to trade that reaction. Now, a lot of times if price is in a trend like this and you have an area of supply like this, a lot of the times you will see that price will come back into that supply and then continue lower from that supply. And that is the concept that we use. And again, that's something that we're going to get into in just a moment. So again, if we just go to mapping out our areas of supply and demand, we can come back again and understand this is where demand comes in. Again, we come down. Then what happens? Supply comes in. Price starts selling. So we understand if we take this candle right here and we count one candle bullish, second candle bearish, third candle bullish, notice that candle 1 and candle 3 do not meet. So there's candle 1 and there is candle 3. Notice that at the time that happens that there's an imbalance. And then what happens? Price comes back, fills that imbalance, has a reaction, has some selling, but then continues moving higher. Why? Because price is bullish. So in this specific scenario, you can see that price neither respected this area of demand nor this area of demand. Now that's okay. It doesn't have to happen every single time, but understand it as a framework. Understand it as a catalyst that pushes price, which you will begin to understand. So if we take that framework and we continue moving price forward, again, what we'll notice is that demand comes into the market and the only area of imbalance there is this right here. So we have a sell candle, a buy candle, and another buy candle. So the first candle of the sell, right, the highest point, to the lowest point of the third candle, like this, they don't touch each other. That is imbalance, right? So that's an area of demand. And lo and behold, at some point, again, there's a lot of different things you have to piece together, and we're going to get to that. But at some point, price taps into this area, taps into this area, gives some bullish reaction, and then continues going lower. The reason for that bullish reaction is because it's interacted with a bunch of buy orders that were sat there previously. The question just becomes, is there more buy orders in this than there are sell orders at this area? And that is really most of the time dependent on our directional bias. So then price increases again and leaves behind another area of demand. We look at this bearish candle right here, right? To the next candle is a bullish candle, and then the next candle is a bearish candle. Again, notice it's fine line, but it's about training your eyes to see it. The first candle and the third candle don't touch each other. That leaves imbalance. That means this is our demand zone. And in this specific scenario, this is the demand zone that gets respected before putting in a higher high and continuing higher. And so that is the concept of supply and demand, and also more importantly, how to use it as an order block framework. So what we're going to do now is we're going to move into where we are right now with price action, and we're going to apply the two concepts that we've just learned before moving any further. So concept number one, we need to have our directional bias. So as of right now, what do we have? We have price was bullish, our directional bias was bullish. Then we changed character, price shifted bearish, price put in a lower low, lower high, lower low, lower high, lower low. So right now we are bearish. That means our directional bias is bearish. Okay, cool. So we've got that out of the way. So if our directional bias is bearish, we only want to be looking for shorts. Now we need to add in supply and demand. We need to identify an area of opportunity that we can potentially get involved in the market. And we do that by mapping out supply and demand. In this scenario, what we see happen is demand comes in, supply comes in, demand comes in, supply comes in, we break structure. The only unmitigated portion of price right now is where? See if you can identify it yourself before I give it you. Got it? Okay. The area, if you said this candle right here, you are absolutely correct. That is the candle that we use. It is the bearish candle, bearish candle, bearish candle. So it's three bearish candles, but notice that the first candle and the third candle don't meet. The only reason they don't meet is because such a large volume of orders come back into the market. It leaves a gap in the market, which was an unfair opportunity for sellers. Buyers were offered liquidity at that area of price, meaning that price will likely at some point come back and fill it. In the process of filling it, what do we have? We have an area of orders, right, that exist in this area for price to collect. And if there are enough sell orders, then there are more buy orders that come into the market, then price will decrease. And just by using that logic, we identify an opportunity. That is to potentially look at getting involved in the market in this supply area, taking price lower. But now we need to move into steps 3, 4, and 5 because we aren't done yet. We've built our foundation, and our understanding of direction and supply and demand is a huge importance. But there are a few little details that take you from a good trader to a great trader. And those are in the details. So let's move on to liquidity as a cause. So let's take a look at liquidity concepts. Now, don't be fooled by everybody overcomplicating this idea of liquidity. It is stupid simple. Liquidity is just another word for money. So ask yourself, where is the money in the market? The market has one job and one job only: seek liquidity. This market operates as an algorithm. The job of the algorithm is to offer liquidity, availability to get into the market, to all market participants. So let's say you have an order book and there are a bunch of buy and sell orders inside of this book at different areas of price. The goal of the algorithm, just like a magnet to metal, is to gravitate toward those pockets of liquidity and collect the orders. That's it. That's all liquidity is. It's the understanding that the primary objective of this market is to gravitate into pockets of liquidity, but it's also to create pockets of liquidity. Why, you may ask? Because this is just a business model for the market makers. The market maker gets rewarded by offering you ease of access into this market, meaning for every buy there has to be a sell. So if you want to short, then they're going to provide you the equal liquidity and long. It's essentially the concept of debooking, but really it's just offering you the liquidity to get into the market. And why do they do this, you may ask? So that they can make the difference between the bid and the ask that they offer you. So you want to get in at this price and they will sell it you at this price. So they make a small amount in between each and every transaction. So they need to make it as liquid as possible, meaning ease of access in, and they want to make as much liquidity as possible. And finally, they want to collect as much liquidity as often as possible. The more liquidity they can collect, the more money they make for themselves. It's stupid simple. So then you ask yourself, where is liquidity? Where are liquidity? What is liquidity? What is this overcomplicated holy grail that people are talking about that's really just stupidly simple? Where are the orders and where are the stop losses? There are only two types of liquidity. There's an order in which you get triggered and money comes into the market, or there's a stop loss in which you are triggered out of a position, money flows into the market. That's it. So you have to ask yourself the question, where do traders like to get into the markets? So you want to look and diverse yourself, and we know we call it retail traders, but really and truly it's any liquidity. Where are their orders in the market? Some of the most common ones that you may see are things like equal lows or double bottoms or support. You may look at equal highs or resistance, trend lines, equal lows. Like these are the most common ones that you'll see, but there's also many others. And the simplicity of it is liquidity is just understanding where are the orders in the market, because like a magnet, price is going to gravitate toward those orders. Okay, now it's picked up these orders, right? Let's say hypothetically speaking, it sees this liquidity, the market goes and grabs it. Okay, now where is it going next? It's going to wherever the other orders are. It's going to go and collect those orders. Okay, now it's going to come back down to balance price, to collect orders, to continue. Where is the liquidity? The liquidity is on both sides, right? We've just created liquidity by bringing price in to sit at these and create equal lows. The algorithm has created liquidity, and then it goes and takes liquidity, and then it goes and takes more liquidity. So the algorithm is constantly creating and taking liquidity. Now, why is this important to us? We understand the market is always going to gravitate towards where the liquidity is. So by that very distant nature, we can just avoid putting our stop losses and our entries in liquid areas. And actually we can begin to target these areas as things like our price targets. Because we understand that price is going to gravitate toward that area, why not target it as liquidity? So without getting into this and making it too complex, because it really doesn't need to be, the market is just operating as one big machine that wants to grab, create, and collect liquidity. So when you see things like trend lines that are being built, they're likely being built for some future event so that price can come and take out liquidity. I mean, however you look at trend lines, whether you look at trend lines, something like this, something like this, something like this, however you look at it, there are pockets of liquidity in all areas of the market. And at some point it was purposely designed to get people into the market to later take them out, because all it is just providing liquidity. There's nothing wrong with it. They're not doing anything wrong. They're just collecting the orders that rest there. And it just so happens to be that humans typically follow each other. And so there are many traders who trade the same systems. So the algorithm gets smart and it begins to understand where are these orders, and it begins to create them itself because it understands the certain chart patterns or psychology that goes into why traders buy and sell. And so it's designed basically off that in a way where it's just provided to offer you the liquidity, ease of access. In doing so, it by design hunts stop losses and hunts orders. But there's nothing wrong with that. It's just doing its job. The algorithm isn't bad, it isn't good. It just has mechanical operations. It's your job to understand that. So how do we factor in liquidity? Well, we just went through the easy types of liquidity to understand. But if we just pull price back into something like this, let's just take a look at, different areas of liquidity. So, you have your standard kind of trend line liquidity. This becomes a liquid region with a bunch of stop losses above it. Price runs and grabs the liquidity. It just becomes the same thing over and over again. Price creates, relatively equal lows, which is just again creating liquidity for future reference. Price then creates more relatively equal lows, future liquidity points. And what price will do is it will move in one direction, building up the liquidity so that it can then eventually fuel the move into that area. So when you see price trending in one direction, say like this, right, what it's doing whilst it's facilitating its plan, it's building a bunch of liquidity on its way. It's building equal lows, it's building trend lines, it's building internal lows, weak lows. It's creating areas of supply and demand that also act as liquidity, because what are they? There's money in those areas. So the concept of liquidity is just, where are their orders? Where are their stop losses? Preferably you want to remove any orders that put your stops in stop losses in liquid pools, or essentially look at targeting them. So one prime example, and liquidity exists on all time frames, which we're going to take a look at. One primary example, honestly, is that price comes down here and then it begins to move its way up. What has it just done? It's just created perfect equal lows. That we just understand is an area of liquidity. And again, liquidity exists on every time frame because every time frame is traded. So if we go to a lower time frame, what may look like a harmless 2 candles really and truly is more like an area of support created on a lower time frame, right? We understand that price bottoms out, it comes back up, it rejects it, it comes back up, it rejects it, it begins moving higher. What do traders look at this and think? Oh, that is essentially our support. Again, and this happens everywhere. Price creates equal highs right here. Liquidity. What does price do? Price just gravitates into the area. It creates the equal highs, it pushes down, then it comes back up to collect that liquidity. Price pushes back down again. We create, relatively equal highs in here. Again, these are all forms of liquidity. Now, there's a very important concept I want you to grasp, and it's super important. This market operates algorithmically, meaning there is everything is logical. So it can't be subjective. The algorithm is designed to create liquidity. That doesn't mean that it has one rule for one time frame and another for another time frame. What liquidity on the 1 minute time frame is still liquidity. Even though you may look at it and think, oh yeah, why would they put liquidity on the 1 minute time frame? Like, who's going to put their stop losses there, or any time frame for that matter? It's algorithmic. So the bot has been designed to do its job, and the market is fractal. So whatever it does on one time frame, it's going to do on every other time frame. So whether you have that so whether you have an understanding of directional bias, of supply and demand, or of liquidity, it happens and rings true on every single time frame. No time frame individually has a concept that another doesn't. That is how you align yourself with truth. If anybody tells you they have a strategy that only works on one time frame, the likelihood of that strategy is very low, because it's not built on fundamental market truths like the law of supply and demand, the law of cause and effect, etc. So without rambling on, we see we have an area of liquidity. We have a bunch of areas of liquidity that get built, and they get built pre-designed to be taken out at later dates. And again, this happens everywhere. Everywhere you can look is pretty much builds areas of liquidity. We have areas of support as liquidity up in there. We have, areas of resistance. We have areas of equal highs that get left just behind it. We have areas of relatively equal highs that exist right here, and then price wicks up to take the liquidity, and in doing so, price also leaves areas of liquidity. The algorithm doesn't have feelings, so there's no emotional activity behind it. Everything is done through pure logic. So it understands that there are many different traders, an infinite amount of traders trade an infinite amount of strategies, and its job is to design as much liquidity to facilitate them wanting to get into the markets and participate in the markets so that they make their difference between the bid and ask, and also gives ease of access to anyone to liquidly transfer one asset to another. So the concept of liquidity is simply just orders in, orders out. But I wanted to share it with you as it's not one of our most fundamental parts of our system, but I wanted to share that with you because you want to be able to identify liquidity as understanding the more that liquidity gets built in one area over an extended period of time. Once you see that there's no liquidity in any other area, watch how market will gravitate towards to go and collect that liquidity. And what you'll be able to do is target that area or stay away from that area. So I recommend going and testing different areas of liquidity and how market reacted to them over time. And you'll notice that every area of liquidity at some point gets taken because it has to facilitate the orders in that area. It's that simple. It's just a machine operating like a magnet to collect orders. So now we're going to move into multi-time frame fractals, which is a really important concept and is super important for this strategy. So let's take a look at multi-time frame analysis, and we're going to keep it stupid simple again. The concept of multi-time frame analysis is simple. You're using multiple time frames to gain your overall understanding. What this does is it gives you an edge over the higher time frame because you're getting to see the fractalized version of that time frame as it plays out. So as you understand that this market is algorithmic, you may look at time frames as though they're different price action, but really and truly, price action is but one thing and one thing only. Time frames are different viewpoints of that price action. So two time frames aren't different. They're two different perspectives of one truth. Don't forget that concept because don't separate the time frames. Understand that each time frame tells a different part of the same story because there's only one data feed. There's only one price action. So with that said, how do we use it and how does it affect us? Well, for this example, you can see that we have red and we have black. So we're going to go with red as our 15-minute time frame, 1.5, and we're going to go with black as our 4-hour time frame. So black is 4-hour, M15 is red. Step 1, directional bias. Mark out our swing points. We have a high to the low in black. Price pulls back, it's the highest swing point. Price continues, it's the lowest swing point. Price pulls back, it's the highest swing point. So we're bearish. Our 4-hour directional bias is bearish. Right, now let's look at 15-minute. What will happen is as the 4-hour leg comes down, the 15-minute will be bearish. As the 4-hour pulls back and demand comes in, the 15-minute will flip bullish. So when the 15-minute flips bullish, that's our indication that the 4-hour is pulling back. Then at some point, the price will shift from bullish back to bearish, and that will be indicative of the 4-hour continuing to go lower. Then it will shift bullish again, pull back, bearish again, realignment to go lower. Let's look at how that works. So let's map out now our 15-minute, and again, we're going to do that in red. We have a high, we have a low, we have a lower high, and we have a lower low. 15-minute is bearish. Lower high, lower low. So right now the 15-minute is bearish and the 4-hour is bearish. Now look what happens. The 15-minute shifts bullish. Change of character. That change of character indicates to us potential 4-hour pullback, which happens. 15 minutes continues bullish. The 4-hour has its pullback. Then we get a realignment. We change character. Now, this is where we get our edge over the market because in truth, what we're seeing is a forecasting of what's going to happen on the 4-hour because we're looking at the same price action, remember, because there's only one truth, but we're looking at a fragmented version of it. We're looking at an early perception of it. So we're looking at it whilst it's still building its narrative. So when a price changes character on the 15-minute to realign with the 4-hour that's already bearish, we can then assume that now is time for the 4-hour to continue going lower, and it's going to take out this low because that's our expectational bias. So we at this point have assumed that we're going to take this leg, meaning that we've been able to predict by reacting early to this low being taken ahead of time, which is what? An edge. And if you can do that statistically more than not, then you have your edge if the numbers make sense across the other variables as well. So price makes a lower low. At this point, the M15 is bearish. And let's say that area leaves behind an area of what? Supply. We're able to pair our bias with that area of supply, get involved here, and take out this low down here. You see where this ties in together right now? So then price continues bearish, and finally we take out the lows down here, and the M15 continues making lower lows and lower highs. At some point, price shifts bullish for the M15 whilst the bearish for the 4 hour. What does that mean? Potentially now is time to pull back for the 4 hour. And so what do? We understand that we have an area of supply on the 4 hour time frame that's sat right here. We wait for price to make its way back up here, which is what? Bullish, higher high, higher low, higher high for the 15-minute. Once price gets into an area where we expect there to be an influx of supply, meaning it's going to push price down, when we already have a bias of bearish price action, then we can assume, perhaps, maybe, that this is the area that price respects and takes out this low. So again, price puts in a higher high inside of this point of interest, and then we get a change of character, which is our confirmation that price is now going to go lower. We have essentially concluded, and that 15-minute area leaves behind what? Supply. We have essentially concluded that that is going to be respected because the 15-minute is now inside of a 4 hour area of interest. It's also inside of the point of interest. It's also realigned itself, so it's now bearish. And before price has even got down here, we've assumed that that's where price is heading because we have had what? Access to the data before it has happened because we use multi-time frame analysis. Remember, we're not looking at two different data feeds. We're looking at two different time frames of one individual data feed. So that's where it gets interesting, because now we can assume that this low is going to be taken out like that. And that's how we pair expectational bias, our directional bias, with our supply and demand. And that's how we actually get into our positions, which is what I'm going to show you next as I walk through step 5, which is entries, exits, and management. How we turn this theory into the trade I'm going to be breaking down with you in a moment. Okay, so now we are back moving into step 5, putting it together with entries. And remember, we're just going to keep it stupid simple. So remember where we picked up from last time, or left off from last time. Price was bullish, putting in a series of higher highs, higher lows, and higher highs. Price put in a lower low, lower high, lower low, lower high, and has now put in a lower low. So step 1, directional bias. Our directional bias as it stands right now is bearish. Step 2, supply and demand, or order block. We have this area of supply and demand mapped out here. Now here's a key when it comes to understanding supply and demand. You don't have to stick to that specific candle. You can use it as general areas of supply and demand. This is the point in which momentum come into the market. We just need it to have imbalance. So this whole area right here, we are potentially having our eyes on. So we want to set an alert right here. So when price tags into this zone, we're going to be looking for a confirmation, which I'm going to be sharing with you in a moment. So price is what? Bearish right now. So what we need to take a look at, getting into our multi-time frame analysis, is we're going to go down to the 15-minute and remember that the price action is bearish on the 4 hour. So what we have up here and what we have down here is our 4 hour structure. Now we need to get into our 15-minute structure. So what we're going to do is, to understand our 15-minute directional bias, because they exist on all time frames, we understand that this was the high, this was the low, price puts in a higher high. I'm going to use the 15-minute in red. We have a high, low, higher high. Price breaks structure. Lower low. Lower high. Price pulls back. What happens? Where does this low get broken? Right here. So we have a lower low. Then what happens? Price has its 3 bullish candles. 1, 2, 3. Lower high, lower low. Now I want you to notice how we go from such a large trading range from this low to this high to such a small trading range from this high to this low. Don't worry, that's perfectly normal because our plan is mechanical. It's just whatever our plan gives us, we react to it. We have a plan for everything. So it's not subjective. It's not, this looks like it could be a pullback, or this looks like it's going to be a pullback. It's like, no, this is mechanical. There's rules to this. So with that being said, price makes a lower low. That is our current structural range. Now, what do we understand? The 4 hour is right now bearish. In order for the 4 hour to have its pullback, we're likely going to see a shift in 15-minute price to become bullish. So right now, the 4 hours bearish. Right now, the 15 minutes bearish. And if we just play price out, what we will see is that the 15-minute has just shifted bullish, right? We've just had price put in a lower low. The high that put in the lower low has now been broken, which is simple. It's a change of character. Stupid simple. Change of character up. So now we have the low to the high, and we need to see 3 candles as a pullback. Okay, so that is moving our high up to here. We have 1 bearish candle, 2 bearish candles, bullish candle, bullish candle, bearish candle. There's 3 bearish candles. So now we've had a pullback. We don't know when the lowest point is going to be until it breaks a high. So we just know that right now we're pulling back. So if you just play price out, once price, so remember that's a wick, that's a liquidation. It does not count. It has to break and close above that high. But when it does that, like it does right there, now we've broken above that high, break of structure to the upside. Now we have a new trading range. So we look, this was the low, this was the high. Where's the lowest point of the pullback? It's here. Where's the highest point of the continuation? The highest point actually goes here, but only is it considered a low now because we've actually broken structure. So now we have a high and a low, and look, we've just entered into our point of interest. So to get involved in the market right now, we need to see a change of character. We need this low down here to be broken for the 15-minute to go from what was bullish to now bearish. Let's continue playing price. So after price has broke structure, we've had now a series of bearish candles. So we now confirmed that we're in a potential pullback phase. See what price does. Price respects the high. Okay. Price has liquidated the lows, so it hasn't broken the lows. That is not a break of structure. All that is a liquidation. So we haven't changed character yet. Price pulls back up. Price continues making higher. Okay. We've broke and closed below, so now we've had what? A change of character. Now we've had the change of character. What's just happened? We've gone from bullish price action on the 15-minute, right? We was bearish, lower low, higher high, higher low, higher high, change of character, lower low. So now we're bearish. So now we've come into our 4-hour area of demand, and we've shifted from 15-minute bullish to 15-minute bearish, from high to low. So now we can actually get involved in this market by identifying where is there imbalance, where is there an area of supply, and then where are we going to target. So step 2, we understand already from step 1 that our target is going to be this low down here, because this is the 4-hour low. So we already have our directional bias as this target down here. Now we need to understand where we get in. Step 2, let's identify our area of supply. So if we look across, we see that everything has been mitigated. This was unmitigated, then the wick comes back up to mitigate it. Price pushes down. Okay, so there is our area of supply. Pay close attention. There's a candle here that's a bullish candle that goes up. Then it's followed by a bearish candle. Then it's followed by another bearish candle. Now, it doesn't matter how small of a gap it is. This is the high, this is the low of the candle, right? Just up a little bit. And this is the high, that's the high of the low of the first candle, and this is the high of the third candle. Notice that that is a gap right there, albeit it can be as small as it possibly wants to. The point is it's a gap nonetheless, and there is no imbalance anywhere else. So we understand that that point right here, supply come into the market because price pushed down. We've met our criteria because this area has imbalance in it. We can just go ahead and put our area of short. We can cover the high as our stop loss. That is a 13.2 pip stop loss. Where are we going to target? We're going to target this low down here. What does that end up as? Ends up as 1 to 3.86. Now, here at Prosperity Academy, one of our rules is a minimum of 1 to 5 risk to reward ratio. So here's one way that we do things if in case the size of the trade isn't 1 to 5. We will take the Fibonacci tool. From the entry to the stop loss, you'll have a fib, and you can then move that entry up to the 50% region of the area, or you can just have it as a minimum 1 to 5. Whatever suits you best. We need at least a 1 to 5 for it to make sense for our overall numbers. It has to be a minimum of 1 to 5 risk to reward. So that way, even if our risk to reward ratio is 35% of trades that we win, we're still net profitable. It's just a numbers game. So that would be our trade idea. And then we would wait for price. We would place our entry. You can see right there, price just misses our entry, and then price tags our entry. So now we're tagged into our position, and what we're waiting for is a internal break of structure, an IBOS of this low down here to be broken before we take out the lows. And that is how we pair all 5 of those steps inside of that trading strategy in order for you to become profitable. Now, this is one variation of our trading strategy. We go so much deeper into the knowledge and logic behind how the market operates inside of our mentorship program. You can take this trading strategy right here and be profitable. 100% free trading strategy, no strings attached. But if you're looking for that further edge, or you want to be mentored by me yourself, click the link below, book a call with one of our team, see if you fit, and maybe you can join our academy. Hope you guys enjoyed that video.